Thank you for joining me. My name is Mitch Goldberg. We are live, and this is Be the Boss of Your Money. It's a live stream all about personal finance, investing, the economy. We talk about interest rates. We talk about borrowing. We talk about buying homes, buying insurance, anything to do with financials. We talk about it here because the objective here is to help you become the best possible version of your financial self. Today, we're going to talk a lot about the stock market and the economy, mostly the stock market. And, the question is stock market's going up this year. We're up 3% year to date in the Dow, about 4% year to date in the S&P 500, and about 6% up year to date in the NASDAQ. Are we back into bull market mode, or is this simply another bear market head fake that's going to draw just enough people in to just squash them again, and more money is going to be lost? That's what we're going to discuss. So hang on there, hang in. We're going to go through a quick, brief intro, and then we're going to get the show on the road. So away we go. Here we go. Here we go. Here we go. Thank you for joining me. I'm Mitch Goldberg. We're just getting started. You're watching my live stream about money, personal finance, investing. It's called Be the Boss of Your Money. A little cheesy on that name, but I gave it that name because I wanted it a way to say it's easy for your money to take control of you, and it's hard to get out of that. What we want to do is help you take control of your money. Maybe I should have just called the show Money Control. That would have been actually a good name. But I'm going to stick with it. Anyway, be the boss of your money. So right now, about half of the S&P 500 stocks are above their 200 moving day average. And that to me is definitely a huge turnaround from where we were just, a month ago, just a couple of weeks ago. So it's been a pretty big move and a pretty powerful broad-based rally as of late. Okay. So that is good. Just so you know, you cannot invest directly into an index, but you could invest in a security that tracks or mimics an index. Okay, I have to get that across. A lot of strategists, market technicians will say, though, that a good market is when 60% of the S&P 500 stocks are above their 200 moving day average. And a bull market is when 70% of stocks are above their 200 moving day average. We could define a bull market so many ways. We could say a bull market happens when we exceed our old highs. We could say a bull market happens when we're 20% off the bear market bottom. We could say all of these things. None of them really mean anything until much later with the benefit of hindsight. I remember very well in March of 2009, after a gut-wrenching 50% plus retreat in the S&P 500 and lots of blue chip names like Fannie Mae, Freddie Mac, Bear Stearns, and Lehman Brothers, and even Bank of America and Citigroup literally went down to nothing or next to nothing. GM went out of business. So that was a really tough market. And I remember in 2000 when stocks like Lucent, which were 100, went down to under 5. Okay, stocks got wiped out. The NASDAQ was down 80%. So both of those cases, and then we had not to mention the brief but substantial bear market we had in 2020. Okay, when all three of those recovered, people were still very, very skeptical. People were still like not believing in the rally. It took a long time for people to come around and say, wow, we really are in a rally. It takes a long time for people to shake off fear. And it could be the case now. And that's the problem with this. Everything I'm saying now is that it's all about if. I'm not saying that there's a problem with saying if, because everything is an if, then this, if then that, if, if. So I feel if AF. Okay. So boom boom. Hold on. Okay. So if we know we're in a bull market, great, but you don't know till after the fact. But after each substantial market drawdown, it took a while for people to believe in a new bull market. Every strategists, investment people were saying, and consumers, retail investors say, we're not out of the woods yet. We've got this hurdle. We've got the next Fed meeting. We've got the next earnings season coming up. We have the next this, the next that. It was just a nonstop deluge of we're not out of the woods yet. So let me just tell you this. We are never out of the woods. I made a whole video about that, how I hate when people say, but we're not out of the woods yet, because we are never out of the woods yet. But it's also, I think it's sad to be someone who thinks that there's another boogeyman around every single corner. They're always bracing for impact. The fact is, the stock market does well more years than not. It's positive more years than not. Bull market rallies are much bigger than bear market fades. And this is the kind of thing that we need to keep in mind when we look at whether or not we're through a bear market. So does it matter if we're through a bear market? Well, it depends. It's like the other day, someone asked me about a semiconductor stock, and my answer was, it depends. Oh, they wanted a real answer. That was my real answer. It depends. Is it a good investment? For who? What's the risk tolerance? How much time do you have? What's the quality of the company? So that's what we have to take a look at. And guys, I see Eddie is out there. Eddie, thank you for the heart while you're watching this, whether now in the live or in the replay. If you wouldn't mind, give us a thumbs up, a heart, a wow, an applause, a care, whatever, depending on which platform you're watching on. That whatever social media reactions you have, depending on which platform you're watching, it helps spread the good word about the show. And if you have any questions about what we're talking about or anything financial related, definitely hit me up right now in the comments. I will see the question. I will answer it. I love hearing from you. It's the best part about doing the show. All right, so let's go on. All right, we have a big rally in speculative stuff. We have Bitcoin just had a very big rally this year, up over 20%, and other investments, meme stocks are going up again. Okay, so the most speculative stuff is going up the most. Now, you would expect that in a bull market, speculation typically goes up the most, high beta stuff. When we say high beta, that means stuff that moves up and down more than the stock market as measured by the S&P 500. So for example, if the S&P 500 has a beta of 1, then anything that goes up more than the S&P 500 in a up market and down more than the S&P 500 in a down market, that means it has a beta of over 1. So a stock with a beta of 2 would move twice as much directionally as much as the S&P 500, for example. So high beta stocks, high beta things, I don't know if you want to call Bitcoin an asset or not, but high beta stuff is going up the most. So should we call this a new bull market because people are jumping into crypto and meme stocks? No, I wouldn't call it that. Okay. What about stocks that are getting pummeled? Because today was actually a pretty bad day. It's not so much in point wise that today was a down day. It was not a hugely down day today, the major averages, although the Dow went down a lot more than the other major benchmarks. But when I take a look at what went down, it's the magnitude of the industrial stocks that took it on the chin. And that's really what I'm looking at right now. And it's kind of a negative way to see things, but that's how I'm looking at what I look at. I don't make the call in advance if it's good or bad. I just have to read the tea leaves, just like you. I think my reading the tea leaves though is pretty accurate. It does help me make moves in the market, but overall, I'm a long-term investor, and I'm not looking to jump in and out of my stocks. Typically, when I buy a stock, I want to hold it, and I want to hold it for 10 years or more. I like to hold things for a very long time. I wish I had that attitude when I was younger, because people have a tendency when they're younger to try to manipulate things, make things work. They try to force things. They try to use options plays or covered calls, or they're looking to buy bounces. They're looking to buy stock splits and earnings moves. And after you go through that for a number of years, you finally realize you're banging your head against the wall and you're just better off buying good companies. And don't worry if analysts upgrade or downgrade a stock, because I have plenty of stocks that get downgraded, and then 6 months later, someone else upgrades it. You know, so the upgrades and downgrades don't really mean anything to me. And if you took a look at like Facebook, which is now called Meta, so many analysts buy recommendations on the stock, and you get the stock tanked. All right. So let's take a look at the major averages, and we'll get into a couple of things. All right. So let me pop myself in. Let me pull up the first screen. Okay. So first, we're going to look at what caused the Dow to go down so much today. So Goldman Sachs is down 24 points. I don't want to really focus on the percentage, because the Dow, it's the points that stocks go down that count more than the percentages of how much stocks go down. The S&P 500 looks at the percentages, but the Dow looks at the points. So that's why they don't trade exactly in alignment with each other, obviously, because they have a different makeup of the components. Also, the Dow Jones is 30 stocks versus 500 for the S&P. But Goldman Sachs down 24 points. That accounts for about half the drop in the Dow Jones today. But it wasn't just Goldman Sachs that was down. Travelers was down. United Health was down. Honeywell was down. Home Depot, 3M, Boeing, Amgen, JP Morgan, Caterpillar, Amex, Merck, Dow Inc., okay, Walmart, Cisco. I mean, Nike, you have a pretty diverse group of stocks that were down. In fact, 24 out of the 30 stocks in the Dow were actually down. So let's look. So if you want to know what I'm looking at, there's more to it than just Goldman Sachs being down. All right. But let's look at the juxtaposition here, the two stocks of the day. Goldman Sachs was down 24 points, down 6.44%. Yet Morgan Stanley was up $5, almost 6%. So these two stocks, percentage-wise, almost a mirror of each other. Goldman Sachs down, Morgan Stanley up. Why? Morgan Stanley has something that Goldman Sachs does not have. Morgan Stanley has a huge retail book of business. They've got like 13 or 14, maybe 16,000. I don't know how many. Let's say 16,000 financial advisors. Cookie Cutter, I think, doing the same thing. But whatever. They have wealth management to hold up the company, while Goldman Sachs is really focused most exclusively on investment banking and securities trading. Okay. So if you look at the haves and have-nots, it's not all bad out there. So we're looking at some pretty negative stuff. But what I want to get back to is, half the stocks in the S&P are above their 200 moving day average. The markets are pretty positive. We're having this year they're positive. We're having a substantial January effect when the previous year's biggest losers are sold off even more for tax loss selling, and then the selling dries up, and then January turns around, and there's nothing left but buyers. So the stuff that was down the most often goes up the most in the following year in January. That's what we call the January effect. And the January effect this year is very much alive and well. All right. So does a good January effect mean we're having a good long bull market? And these are the things that we're trying to figure out. So let's keep going, though, before we come up with a conclusion. All right. So the Dow was down 391 points. NASDAQ was up 15. Again, the high beta stuff, tech stuff working out. S&P off about 8 points, down 0.2%. It's barely a move. Gold off a little bit, but still it broke 1,900 last week. Oil back up to 80. Why is oil going up again? In one word, China. China is reopening. It's expected now that more oil will be consumed. The 10-year yield was up ever so slightly at a little bit over 3.5%. Let's look at the VIX. The VIX is below 20. We look at this every day. The VIX is below 20. It's said that bear markets don't really bottom until they have a cataclysmic fold, until they finally have, what's the word I'm looking for? A dire moment of crash. And the VIX would usually spike up to like 50 or more. It hasn't happened yet in this bear market that we've been in. And now that it's below 20, the last couple of times this happened. Last 3 times the VIX was below 20 was like March, April of 2022. It happened again in August of 2022, and it happened again in this early December. Every time the VIX gets to around 20, stocks rally to get to that point, and then they fade. And this has been shown that every bull market rally we've had has been repealed. And the VIX is shouting repeal again. Now, everything, as trends go, a trend is a trend until it's not, or as I like to say, everything's okay until it's not okay. So we are getting such mixed signals in terms of, are we in rally mode or are we in bear market head fake rally mode? So there is a really big difference. Also on Thursday, we have earnings coming out from Procter and Gamble, which is the key bellwether for the consumer staple stocks. And we have Netflix coming out on Thursday also. And I think investors are getting geared up for a good number from Netflix. And then the Fed meets February 1st, and we're not sure if the Fed's going to raise a quarter point or a half a point. Inflation is starting to, it's not down. It's not like we have deflation, but it's moderating. We're in the sixes inflation rate in the consumer price index versus the nines. We'll see what the Fed has to say about it. So we're getting mixed signals. The yield on the 10-year note, let's take a look at the bond market. Okay. Yields were a mixed bag today, down a little, up a little. It's just basically directionless. But 3.56% on the 10-year, while the 3-month and the 4-month and the 6-month are 4.6, 4.7. The 1 year is 4.7, almost 4.7%. That is such a steeply inverted yield curve. It's like, oh my God, how steeply inverted can the yield curve ever get? This is about it right now. So the 10-year yield, which is 3.546%, it is shouting. It's shouting recession. But maybe we're just going to get a really big slowdown in the economy and not a recession. JP Morgan and Bank of America both say shallow recession on the way. But others, I'm talking to CEOs of those firms, but other people in Wall Street, heavyweights, strategists, analysts are saying we could skirt by. And others are saying it'll be a severe recession like we've never seen before. So here's the bottom line on all of this. And this is going to bore you to death, because I know what you want. You want me to come out and say, this is it. Everybody pile in. We're going off. We're going up. Or you want me to say, get out now. We'll get back in later. I wish I could give you that answer. And I think I'm smarter than that to try to even give you that answer. And hopefully you believe that too. We could go either way. I think probably most of the damage has been done to stocks. I personally, this is just my own money management, okay, and for myself and for my clients, all right? I personally am not looking to get into the speculative stuff. I'm not really looking to find the securities that could go up the most right now. If you are looking for that, you've got to get into the high beta stuff that we spoke about before. The cryptos, the some of the tech stocks with no earnings yet, maybe some of the SPACs, some of the meme stocks. If that's what you're looking to do, you're taking a lot of risk to do that. It's not something that I would want to do for myself. But I'm not here to tell you what you can and cannot do, okay? At the end of the day, it's up to you to do what you want with your money. If people are delegating their money to me, typically people who delegate their money to me don't want me to do crazy stuff, okay? And I don't want to do that anyway. And if that's what they want to, most likely I would just send that person somewhere else or say not for me. Anyway, what we need to look at is if you're looking for the highest beta stocks that can go up the most right now, That's one thing. If you're looking for stocks that are called dividend aristocrats, companies that consistently raise their dividends, and I'm not talking about stocks with high dividends. Actually, stocks with high dividend yields, like AT&T and Verizon, have gotten absolutely clocked last year. I'm talking about stocks that are really good at raising their dividends, even if it's a small dividend that is raised consistently every year. That to me is worth more in terms of total return than just an old line stock with a fat dividend. So I also find that stocks that pay overly large dividends are typically because these are companies that have run out of growth. They have run out of things to reinvest their money in, and they have nothing else to do with the money. So you're not really buying a growth entity. You're kind of buying something where you're living off the fat of the land, and you can only do that for so long. That's how I look at it. Okay. I'm not adverse to getting dividend income, but I just don't want all my dividend income to come from stocks with big dividend yields. I prefer to get my dividends from companies with smaller dividends that are still in growth mode, but who recognize that they want to raise their dividend consistently. Okay. So we'll talk about ways to get into dividend aristocrats in a moment. So you have to pick your poison. But if you are a long-term investor and you're in the market through your retirement plan or just through your joint account or your individual account, whatever it is, or both, don't let this affect you. Bear markets come and go. We will get through this. Now, are you an individual stock investor? Because sometimes I say, don't worry, the markets always recover. And someone who's in individual stocks could look at me like I have two heads. Well, individual stocks don't always recover. If you're down 60, 80, 90% or more in a stock, the odds are, no guarantees, but the odds are you are never going to get that money back. If you're in index funds that track benchmarks, those recover because the stock market always recovers. And you'll be okay. So it depends what kind of investor you are. Obviously, if you're in individual stocks, you could have done extraordinarily well. We had economic miracles like Home Depot, like Amazon, etc. So you have to pick and choose what's best for you. What I'm saying is it doesn't matter if this is a true bull market we're in or if this is a bear market rally. What matters is how long you're going to be in this market for. When do you need the money from the stock market to pay your financial obligations at some given time in your life? All right. And do you have the ability to not let the stock market scare you out of your stocks? Do you have that ability? Those are the three things that you need to get through any market, because we don't know yet if the bear market's over or if this is just a bear market rally and we're going to retest the lows from last October. October lows are not that far away. Couple of months, that's all. So we have some really good metrics like number of stocks trading above their 200 moving day averages. We've had a number of stocks hitting highs, and we've had speculative investments, speculative assets going up, which I think is more bullish than bearish, actually. Okay. So that's good. But on the other hand, we only have 50% of stocks above their 200 moving day average. On the other hand, we have industrial stocks, which are economically sensitive, all of a sudden doing poorly. We had the New York region purchasing managers index come out, and industrial orders have plunged. So some of the economic statistics are really screaming recession. And the VIX is very low to the point of being in complacency territory, which means we are set up for the VIX to spike up because stocks are going to go down. I could give you both sides of the same coin endlessly. It's circular. And that's what makes this so hard. For me personally, for my clients, it's not hard. We're in it to win it. We're in it for the long term. We take control of our money. We control the things that we can control, like rebalancing, dollar cost averaging, or just being in a plan, an investment plan, and a financial plan that we could live with. Those are the things we could control, and I shall surrender the stock market results to people who are much smarter than I, because I know that over time we'll get the results we need. We just don't know when we're going to get them. That's the key. So I hope this is helpful, and I hope this makes you a better investor. And if you walk away from today's episode saying, you know what, I'm just going to buy quality, I'm going to hold on to it, I'm going to keep investing in my IRA or my retirement plan, I'm not changing a thing, I'm just going to keep going, I'm not going to look. If that's, and that's best for me. And if that's what you got out of this, I am very, very happy. That would make me very happy, because you get it then. And that's what we talk about endlessly. I don't just talk to clients about stocks and bonds. I educate clients about financial planning, about investments, about all of this, because ultimately an educated client is the client who is most likely to stick to their plans and make it to the other side, to down the road to retirement, and they can reach their goals. It's the uneducated clients, the ones who are getting, bro science, or seeing something on TikTok or Instagram Reels say, you should do this, you should do that with your money. Some guy on YouTube. I'm not knocking everybody on YouTube. Some of the guys on YouTube I really like a lot, but some of them, their advice is more, I think, to scare you to watch for the views than to educate you. Or if they're educating you, it's really more like they're giving it to you with such a twisted bias to, I'm going to educate you, but I'm only going to talk about the bad things to educate you on, or I'm only going to talk to you about the good things to educate you on about. So that's what I mean. Anyway, I'm going to get going. Thank you so much for watching, and I will see you tomorrow.